Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the sometimes confusing world of business reports and filings. This is not your average financial report, it's like a treasure hunt for business secrets. Let us dive in. Today we are dissecting Forum Energy Technologies Incorporated their latest quarterly report. This document gives us a peek under the hood of their financial health. So as of late October 2025, Forum Energy Technologies had about 11.4 million shares of common stock out there. Remember that number, it will be useful later. First up, the big picture, the income statement for the 3 months ending the 30th of September of 2025 paints a somewhat challenging picture. They recorded a net loss of almost $20.6 million on revenue of about $196 million. That is a significant loss compared to the same period last year when the loss was closer to $14.8 million. Basically, they are spending more than they are earning, and the gap is getting wider. Now let us look at their balance sheet as of the 30th of September 2025. This shows us what they own and what they owe. They have total assets of about $770 million and total liabilities of about $473 million, leaving them with about $297 million in equity. This means that the company owns more than it owes, which is a good start, but looking closer, the current assets like cash and inventory are down from the end of 2024. Their net inventories are listed at $248.3 million as of the 30th of September 2025, down from $265.5 million at the end of 2024. This decrease might be good if they are selling off excess stock, but it could also mean they are not stocking up as much for future sales. They also reported an inventory write-down of $16.5 million. It sounds like they are strategically cleaning house by consolidating facilities and discontinuing certain products. One interesting item here is goodwill, a kind of intangible asset that often comes from buying other companies. Their goodwill is listed at $63.8 million as of the 30th of September 2025, up slightly from $61.7 million at the end of 2024. This increase is mainly due to currency translation, which basically means the value of their foreign assets went up when converted to US dollars. They also have intangible assets like customer relationships, patents, and trade names adding up to about $97.2 million. These are valuable, but they get amortized, meaning their value slowly decreases over time. The company has been gradually reducing the value of these assets as they are used up. Let us talk about debt. They owe $138.5 million in long-term debt after separating out the current portion. This is down from $186.5 million at the end of 2024. They have $100 million in 2029 bonds and about $42.8 million borrowed on their credit facility. Those 2029 bonds have a pretty decent interest rate of 10.5%. They have financial rules they need to follow, like keeping a leverage ratio below 4.0 and having at least $25 million in cash. As of this report, they are keeping up with these rules. Their credit facility is for $250 million and it is tied to their accounts receivable and inventory. As of the 30th of September 2025, they had borrowed about $42.8 million and had about $85.7 million available. This gives them some breathing room if they need extra cash. Looking at their cash flow statement for the 9 months ending the 30th of September 2025 gives us a clearer picture of where the money is coming and going. They generated about $48 million from operating activities. That sounds good, but remember they had a net loss of $11.7 million during the same period. The difference comes from things like depreciation and inventory write-downs, which are recorded as expenses, but do not actually involve cash leaving the company right away. In their investing activities, they had cash come in from sale-leaseback transactions, which brought in about $14.6 million. This is a smart move to get cash from assets without losing access to them for operations. In contrast, last year, they spent a huge $150.4 million to buy another company. And then there is financing activities where they used about $72.4 million for the 9 months ending September 2025. This was mainly due to paying back some of their credit facility and buying back their own stock. This is a sign they might be trying to manage their debt and boost investor confidence. When we look at the total equity side of the balance sheet as of the 30th of September 2025, it stands at a little over $297 million. This is down from almost $320 million at the end of 2024. This decrease largely reflects the net losses the company has incurred. Let us dive into their business segments. They have two main ones, drilling and completions and artificial lift and downhole. The drilling and completions segment brought in about $117.5 million in revenue for the third quarter of 2025, down from $123.6 million in the same period last year. This segment is struggling and reported a net loss of $13.6 million. This is a significant drop from a profit of $7 million last year. The artificial lift and downhole segment, however, is doing a bit better. Revenue was $79 million, down from $84.2 million last year, but it still made a profit of $11.8 million. This segment is actually showing growth in its operating margin. When you combine the segment results and add in corporate costs and other expenses like interest and foreign exchange losses, they ended up with a loss before taxes of about $10.5 million for the third quarter. This is slightly worse than the same quarter last year. And here is a key figure. The income tax expense for the 3 months ended the 30th of September 2025 was over $10 million. That might seem strange when they are reporting a loss, but it is likely due to adjustments in how taxes are calculated for interim periods and potentially due to deferred tax assets and valuation allowances. The basic earnings per S-share for the 3 months ended the 30th of September 2025 was a negative $1.76, which is worse than the negative $1.20 from the same period last year. This means for every share of stock you own, you are losing money. Looking at the 9-month period from January to September 2025, the revenue was about $589 million, down from $615 million last year. Both segments saw a revenue decrease. The total segment operating income for the 9 months was about $7 million, down significantly from $27.9 million last year. Again, the drilling and completion segment is the main drag on performance, reporting a loss for this period. Corporate expenses also went up by about 13.3%, which they attribute to higher incentive compensation and professional fees. Their interest expense more than halved in the 9-month period compared to last year. This is good news and reflects their efforts to reduce debt. The income tax expense for the 9-month period is over $20 million this year compared to about $10.6 million last year. This increase is partly due to adding to their valuation allowance on deferred tax assets. For the 9 months ended the 30th of September 2025, the loss per S-share was about $0.97. This is much better than the $2.59 loss per S-share from the same period in 2024. So while they are still losing money, they are losing it at a slower rate for the year to date. Now let us talk about liquidity, how they handle their cash. As of the 30th of September 2025, they had about $31.7 million in cash and cash equivalents. They also have $85.7 million available under their credit facility. They seem confident this is enough to keep operations running for at least the next 12 months. They are pretty direct about their confidence in their ability to fund operations. They are also planning for capital expenditures to be well below $10 million for the rest of 2025. Mostly for replacing old machinery. Interestingly, the company has a stock buyback program. They have already bought back shares worth about $21.3 million in the first 9 months of 2025, and they still have about $53.7 million left in their authorization. Buying back stock can signal confidence from management, but it also means less cash is available for other things. For the 9 months ended the 30th of September 2025, operating activities provided about $48 million in cash. This is down from $53.7 million last year. While they made more profit after accounting for non-cash items, the overall net working capital generated less cash this year. Investing activities provided about $10.3 million this year thanks to those sale-leaseback deals. Last year, however, they used a massive $155.9 million mainly to acquire Verapam Holdings Limited. Financing activities used up about $72.4 million this year, in contrast to providing $89.4 million last year. The difference is because they took out less on their credit facility, paid back debt, and bought back stock this year compared to last year when they borrowed more and got a term loan for that Verapam acquisition. Now, for the leadership say-so, the CEO and CFO both certified that they have reviewed the financial reports and that they believe them to be accurate. This is a standard but important step in ensuring transparency. An interesting detail is that no directors or officers adopted or terminated any trading plans during this quarter. This means their stock trading activities were pretty consistent this period. The company repurchased over 634,000 shares in the third quarter of 2025 as part of their announced buyback program. This shows they are actively managing their share count. Looking at this report, Forum Energy Technologies Incorporated is a company in transition. They are facing some headwinds with declining revenues in their drilling and completions segment and a challenging market. The good news is that their artificial lift and downhole segment seems to be holding its own and even showing some margin improvement. They are actively managing their debt and generating operating cash flow, which is positive. However, the overall losses and the increase in inventory write-downs suggest they are feeling the pressure from market conditions. The stock buyback program could be a sign of confidence or an attempt to support the stock price. Their future likely hinges on their ability to navigate the volatile energy market control costs and perhaps gain more traction in the growing renewable energy sector, as they mentioned earlier. The net loss for the quarter and the year-to-date improvement means they are moving in the right direction, but it is a slow climb. The significant tax expense despite reporting losses is also something to watch closely as it impacts their bottom line considerably. Alright, that is our deep dive into Forum Energy Technologies Incorporated's latest quarterly report. What are your thoughts on their performance and their strategy for the future? Let me know in the comments below. If you found this analysis helpful, please give this video a thumbs up and subscribe for more of these corporate breakdowns. And hey, if you want to dive deeper into financial analysis and connect with other keen observers, join our Discord community. It's linked in the description. Thanks for watching, and we will see you on the next episode of Corporate Decoder.